Welcome to the second half market outlook. My name is Steve Brice and I'm the bank's Chief Investment Strategist. Broadly, yes. There are two elements of reflation, growth and inflation. Global growth is expected to accelerate materially this year for the first time since 2010. Meanwhile, growth forecasts have generally been revised up over the past 6 months on the back of a stronger than expected recovery in Europe and Asia ex-Japan. For inflation, we have seen inflation expectations decline on the back of lower oil prices and less pass-through from wage increases. We see this as temporary and expect inflation to pick up gradually in the coming 6 to 12 months. From an economic perspective, it means that the global economic expansion still has some time to run, in our opinion. Most economic cycles come to an end because high inflation forces central banks to focus more on controlling inflation rather than supporting growth. The recent decline in inflation suggests this date may have been pushed into late 2018 or even 2019. This in turn suggests that the current equity bull market is likely to extend in the coming 6 to 12 months. This view is supported by the upturn in corporate earnings expectations, especially in the Euro area and Asia ex-Japan. We expect G3 government bond yields to move gradually higher as the economic recovery continues, inflationary pressures build gradually, and central banks unwind some of their previous stimulus measures. However, we do not believe that we will see a sustained and massive spike in yields. Therefore, we still see some areas within bonds that are likely to deliver positive returns. Our favoured areas of the market are emerging market government bonds, both US dollar bonds and local currency bonds. A key assumption here is that the US dollar does not strengthen significantly, a view that has worked out well for us so far this year. We believe real interest rate differentials, that is, interest rates after taking into account inflation, are far more important for the US dollar's outlook than nominal interest rate differentials. In our opinion, real interest rate differentials are unlikely to move significantly in the US dollar's favour going forward. Therefore, we have a range-bound to slightly bearish outlook for the US dollar on a 12-month basis. Against this backdrop, we expect the euro to appreciate. But despite our overall US dollar view, the Australian dollar may be vulnerable, given recent weakness in iron ore prices and the narrowing in interest rate differentials against the backdrop of a fragile Australian housing market. Thank you for joining me.